Hey all, so here's the third video on the practice exam. So we'll start with question 5. This is an inventory question where we've done a count and we have a bunch of issues and you have to identify whether these issues should be in inventory or not. So again, important to read. We want to calculate the correct inventory at December 31. So we have inventory as stated or whatever of 43,100, right? That's from the question. And then we've got A, B, C, D, and E, where we have to address whether or not we need to adjust for these things, okay? So inventory was stated at this, we made some mistakes, some events that occurred are as follows. So A, units shipped to a customer January 2, 2011, costing $7,000 were included in inventory at December 31, 2010. The sale was recorded in 2011. So these goods were included in inventory. Should they be? Well, yes, because we didn't sell them until January 2nd, and we recorded the sale next year as well. So this is all good. Right, so that's kind of the analysis. It's as much a reading comprehension question as anything. B, units costing $17,000 received December 30th, 2010 were recorded as received on January 2nd. So I didn't record them till 2011, but I got them in 2010, so they should be in my inventory. And quite honestly, I don't really care about the descriptions here, whether you have them or not, but I need to increase my inventory for these things that I didn't record until next year. C, units received during 2010 costing $5,300 were recorded twice in the inventory count. Well, if we only received them once and we recorded them twice, that just sounds like it's wrong. So we need to take that out, one of them. D, this one I originally screwed up on the solution, if you saw the early solution. Units shipped to a customer December 28 FOB shipping point, which cost $11,000, were not received by the customer until January. The units were included in ending inventory. So should they be in ending inventory? Well, we sold them to a customer FOB shipping on December 28th. So they should have come out of our inventory as soon as we shipped them on December 28th, and therefore they should not be. So we need to take these out. Minus 11,000. And E, units that cost $5,600 that were shipped on consignment were not included in inventory. Wording could be a little better there, but essentially we have consignment goods somewhere else. Those are still our inventory, so we need to get those in as well. And then make sure you answer the question. And there are marks just for the setup, right? To demonstrate that you read the question and kind of understand the answer, but that should do that one. Easy one for part marks as well. I mean, if you get half of them right and you set it up right, you're probably going to get, 6 marks out of 10 kind of thing. Question 6. We're looking at impairment. Okay. So there's an A and a B. A, we want to calculate the recoverable amount, calculate the impairment loss, and prepare the entry. So we're using rational entity, that's IFRS. So again, the numbers we care about, this is what it's on the books for. This is the value in use. And this is the fair value less selling costs. So I need to figure out the recoverable amount. And that's just the greater of 58 and 62, right? Right? Recoverable is, what would a rational person do? Would they sell it and get the fair value? Or would they keep it and use it and get the value in use? And in this case, we would sell it because it's worth $62,000. Calculate the impairment loss. Well, it's on my books for 70, but I can only recover 62, so I've got an $8,000 loss. Again, on the exam, if you're doing an Excel, don't worry about shoving answers in places like this. I should be able to find them, and everything's all set up, so why not? And then prepare the entry. So I got a debit, and this is a loss. And the account we need to credit is the accumulated impairment loss. So that's A. B, same information above except for we have a new value in use and a new fair value. So calculate the recoverable. Again, it's the greater of these two numbers. So the recoverable is 73,000. Calculate the impairment loss. Well, I can recover 73. It's on my books for 70. I don't have an impairment loss, right? It is worth more than what's on my books. So no loss. Okay, so that's rational entity impairment method. That's kind of sort of what a question's going to look like. Again, it might ask for depreciation entry the following year, in which case, I mean, I don't even have a depreciation policy here, but realize it's going to be based on the new carrying amount of 62,000. Yeah, other than that, there's not a whole bunch else to do with these types of questions. And question 7. We are looking at doing depreciation, straight line, double declining, and CCA for this asset in 14 and 15. So, cost, residual, depreciable. For straight line, I need that. I don't have units of production here, but that would be a fair one to ask too, and they'd give, hours or miles or kilometers or whatever to do usage. Sorry about the phone again. So we acquired the equipment cost of $310, installation and delivery cost of $25, and employee training costs of $8. It's supposed to have a residual of 20, and the present value of disposal costs are 10. So we also have built into this question that we have to know what gets included in cost. And the only thing that's a little weird here, so I've got the 310, right? What we paid for it. Installation and delivery is part of the cost. Training is not. You can't include employee training costs in capital. That's an expense. But I do need the disposal costs of 10,000. Okay? So 310 plus 25 plus the 10 of disposal. The residual is 20. And the depreciable is like so. Useful life, 5 years. Youthful life is pretty close. So my depreciation rate is 65,000 per year. So let's, again, just kind of set it up so it's easy to follow. I need to calculate depreciation for 14 and for 15. And for 14, well, it's 65,000 a year, and then I just check my dates, and I see again, I bought it March 1st, so I've got it for 10 months out of 12. In 2015, I've got it for the full year. Okay, double declining balance rate we need to calculate. It's equal to 1 divided by the number of years in straight line. So that is my straight line rate, and then I need to double it. Double declining balance. And again, I ignore residual when I'm doing double declining balance. So it's just going to be the cost times my rate. And then again, this first year is March 1st, so it's times 10 months out of 12. And then the second year is my carrying amount, so my cost minus whatever depreciation I booked last year times my rate. Okay. CCA, again, the two differences that you might see. One, in the first year, we always take a half, regardless of number of months. And two, we don't include restoration costs. So my cost base for CCA purposes is going to be the 310 plus the installation, but it's not going to include the disposal costs. So 335 times my CCA rate, which is always going to be given, it's 30, and in the first year it's times a half, and then in the second year it's my carrying amount for tax purposes, which is the 335 minus the 5250 times my tax, or my CCA rate. I did? Okay. So that pretty much highlights everything that you're going to see on depreciation. Other activity-based, but again, calculation there, same as straight line. Hope that helps. Thanks all.